No one knows exactly how the macroeconomic environment will play out, but it doesn't hurt to be aware, especially if the environment is starting to change for the worse, and it doesn't hurt to be prepared. Or as Charlie Munger once quoted, I believe it was, "The thoughts of others were light and fleeting, of lovers meeting or luck and fame, but mine were of trouble and mine were steady. So I was ready when trouble came." And I think the reason why he quoted that is to reflect that even if you do have a recession, even if you do have a tough period, if you prepare for it, if your mind is prepared for that eventuality, that event, which will occur at some point, there are always stressors that play out, you're more likely to react in a healthy way and ultimately make your own circumstances better. If you enjoy educational investment videos, you're watching Unrivaled Investing. My name is Daniel. Let's dive through some of the latest macroeconomic developments, as well as sort of a checklist that you could consider in the event that things do turn sour. So the latest news, which just came out from earlier today, is weakening home sales data coming in significantly worse than investors expected, where now you're starting to see home sales hit a multi-month low, 6-month low, reflecting that interest rates and higher prices are catching up to the consumer. Looking at credit card balances, delinquency rates now higher than they've been throughout COVID, now pretty much at a high that's comparable to where we were recovering from the great financial crisis. So this is a bit alarming because credit card debt is typically very expensive, 20 to 30%. So this does reflect that consumers have really worked off any sort of savings and extra benefits they got during the COVID boom, where there was direct stimulus, which is also alarming because the US government's already running a 6 to 7% deficit. So, you're looking at multiple challenges going on here. This increase in delinquency certainly is not good. And the sharp move higher, I'd argue, is not favorable, especially when you consider, potential consumer purchases. Looking at the small business index, I'd say it's broadly meh, where they saw a slight uptick, 0.2%. This is a small business index that tracks literally millions of businesses. And while there was a very, very slight uptick, they did notice that transactions were actually down 0.5%, which does reflect that, and while prices might be higher, to deal with inflation, customers are effectively just buying less, where they're saying, hey, if I have to, pay more for certain things, I'm just going to be transacting ever, so slightly less. And it's a mixed picture in terms of what's not doing so well, like retail and professional services, and what's holding up, like food and beverage. Looking at one business that has not done well and is really waving a bright red flag just from earlier this week, that is Pool Corp. And this is, in my opinion, a very strong signal about consumer behavior, how they're doing, because Pool Corp provides key supplies for swimming pools, outdoor living projects. They noticed an 11% decline in the building materials, which suggests the consumers are prioritizing essential expenditures. This was, I was asking AI Ticker Chat to summarize their recent press release that came out just earlier this week. They talked about how this is Pool Corp is seeing a 15 to 20% decline in new pool construction, which is a little bit surprising, partly because, this decline is significant because you are now talking about summertime. This should be peak, swimming pool. Everybody's happy, like, hey, we want to make sure it's up and running for swimming. You want to be showing off your swimming bod. All those people getting their GLP-1s, they're like, hey, I want to show off that new Speedo or bikini. And so, this is for them to talk about what I'd argue is pretty significant weakness, 15 to 20% decline, does reflect that consumers are just spending on the maintenance, the cleaners, the pool cleaners, and any sort of big projects that's getting pushed out. And as a result, their projected earnings, and this is actually going to be quite a significant deal and read through, I think, to a lot of companies, we'll talk about that in just a second, is the EPS, or the earnings per share, that is going, they're revising it from around 13, 14 to 11. Why is this important? So if you have companies saying, hey, our profitability is going to get slashed by 10, 20, 30%, you need to think the secondary effects. What are some of the secondary effects from that? Well, if you're running the budget for these companies, and all these companies with major consumer line items are now going to be thinking this, they're going to say, wait a second, we want to make sure we actually hit that profit figure, this revised lower profit figure. So this means any new hiring, you can forget it. Any new large, expenditure, you can forget it. And so you can start to see how you get this sort of spiral effect, because when companies are now seeing a revised lower EPS like Pool Corp, and Pool Corp, you look at the stock chart, it has done extremely well over a multi-decade, multi-year perspective. For them to be talking about this does reflect, I'd argue, not their own execution weakness, but broadly a much weaker consumer. And them saying, hey, our earnings are going to get impacted, will have read-throughs to a lot of companies beyond just this consumer discretionary. That's what I would suspect over time. So this is sort of a red flag for investors to be aware of, that, consumers are focusing on preserving existing assets rather than taking on new financial commitments, avoiding large-scale projects, financial conservatism. I think this is super important to recognize that there's a change in environment afoot. And so what is sort of the bear market checklist? If this is indeed the beginning of something much worse, going to play out, what are some of the things that you should, think about, be mindful of? Well, first of all, in full disclosure, this is not financial advice. Also, quick plug, just this past week on our exclusive Discord server, a premium member wrote, this is a direct quote, "First of all, I would like to thank you for all the knowledge that you share with us. You have helped me a lot in my investing journey. I've managed to turn £3,000 to £500,000 in 4 years with a regular salary. This is one of the stories that really makes my heart sing. I'm really glad to hear that the Unrivaled Investing community is helping out the subscribers. So if you're interested in finding compelling investment ideas where I share my own personal investment journey, come check it out. That's at unrivaledinvesting.com. So thinking about the checklist, I think really you do need to have some sort of emergency fund. You do need to be prepared. Everyone's different. Everyone needs to think about what's right for them. Some people say a couple of months. Some people say a couple of years. You have some businesses like Microsoft where they're like, hey, we want to have enough cash where if we had zero revenue for the year, we could still run. That's obviously not going to happen with Microsoft. But I think this is it is important for you to reflect on what could be, what do you need before a recession, before you potentially, get some sort of impact with your job or salary. What do you need to have set aside before you consider any sort of investment? So that's the emergency fund aspect. I think it doesn't hurt to have cash. I personally keep my cash at Interactive Brokers, which yields nearly 5%, 4.8% plus. I also do reflect on what is my total purchasing power. So if, that gets back to that Charlie Munger comment about, the thoughts of others and being prepared, if I look at my Interactive account, I'm thinking about, okay, how much is it going to potentially cost me? If I do want to margin out my account, how much am I willing to borrow? What's my potential liquidity? What's my purchasing power in the event of, let's say, a sharp recession where all of a sudden I'm starting to see, bargains where I'm going, wow, I really want to go 100% plus, all in. And you could see how Interactive Brokers, their rates are significantly more favorable versus the E-Trade, Schwab's, Fidelity's of the world. I mean, by several percent in terms of US margin rates. And so that is one, being aware of not only my cash balance, but what is my purchasing power? That's also a critical thing. I think another key aspect is thinking long term. That means being prepared. So if you're a pool shareholder, for example, I don't own any pool shares, but if you're a pool shareholder, you see this type of event, you're focusing on what does this business look like in 3 to 5 years from now. You might look at a quarter's result as long as it doesn't disprove that thesis for where you think, long term, and unless you're doing some sort of trading. That's not my game. I'm trying to focus on, long-term ideas, companies. I don't want a lot of turnover. I want to find, like my personal, vision is to own and align myself with founders where I go, I love what they're working on. I understand why they're winning. They have a history of winning. For example, one of my top holdings is Fairfax. I've talked about it before. I save most of the detail for my subscribers at Unrivaled. But the key aspect there is you have a track record, multi-decade track record of significantly beating the market, aligning with management, a service, good or service that, truthfully, it's a lot less discretionary. Insurance is a lot less discretionary than buying a new pool or getting, the pool equipment, buying some pool noodles. So, that sort of vision, reflecting on what is your goals for your investing, what type of businesses do you want to own? And, looking at, yes, there are going to be challenges. Everyone faces challenges. Everyone will have hardships. Everyone will get punched in the face. Now, there'll be different types of hardships and challenges, but it's how you react when you're punched in the face. That's what matters. And to be prepared for that sort of environment, and to be prepared is to have that vision of, okay, well, what am I working towards? And, why do I own this? We'll talk about that in just a second. I think another key aspect is to be aware of your different, effectively the balls in the air, the different positions that you might be juggling, because some companies might be rocketing higher. Some companies might be more, diversified geographically in nature. So you want to be just mindful of your position sizing. The time to think about it, I'd argue, is now versus when it's very aware to everyone, like, ooh, this is not good. There's all these things that are building up, but so far the markets really aren't reacting to it. Now is the time for you to think about, okay, is this position too big? Do I want exposure to, gold? Do I want exposure to, Brazil? Do I want, US treasuries? Do I want companies that, maybe it's a fusion type of stock where they haven't proven their business model yet, but hey, I really like the potential. Now is the time to be thinking about your position sizing for the different positions. And if you're not familiar with how to do that sort of research, or you want some assistance, there's a lot of different ways for you to do it. Some people, get professional advisors. I've been working with my partner, Steve, with AI Ticker Chat to make it easier. He's my business partner to make it easier for investors to analyze, businesses. So we have Scorecard where, you can more easily understand some of the key aspects of a business, whether or not it's the analyst sentiment, financial health. So the time to understand, I'd argue, the key risks of the business and whether or not it has a good balance sheet and can withstand a recession. Now is the time to do it, to sort of size up the financial health of the businesses that you do own, or the exposure that you do own. Well, what's the market position? Are they winning? Are they losing? And I think the last aspect is I wrote, don't panic, or I posted this here. It never helps to panic when that inevitable punch in the face happens. That said, if there's a time to sell, it's when, everyone else is like, maybe I should buy some more Nvidia because the stock's up 1,000 bazillion% in the last month. The time to panic is generally before everyone else does, if there is ever a time. So I think it's worthwhile for you to go through your portfolio line by line, position by position, to reflect on, is this, if it's a big stake, do you want it to be that big? And do you agree with where it's heading? And if it has a challenge, let's say in the next year or two, would you be happy that it's a certain size? So to reflect on each of those positions, or you say, okay, well, let's take it one quarter at a time and assess. I hope this video talking about the current macro as well as a bear market checklist has been helpful for you. If so, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for watching Unrivaled Investing.